Stock investors have doubled their money in just 2 years, with stocks like Tesla and Enphase taking investors' profits up 10 times their money. But of course, that was only for those with money in stocks. For beginners, the stock market can be paralyzing, seem like a foreign language of numbers and percentages. That's how two citizens of the Bowtie Nation, Bryan and Crystal, felt, and it kept them from getting started for so many years.
I've always knew investing was out there, but you've always heard people say it's too risky. That's what has stopped me from all the years past when I've thought about it. It's just, if you don't have a lot of money, you're scared to lose it.
That fear and confusion kept them from investing for too long, missing out on so much. I want to change all that for you with this video, give you a complete guide to the stock market for beginners, and make stocks seem simple.
I'm very confident that our investments are gonna definitely pay off and make us money.
I mean, it's hard to explain the feeling of excitement, like, we're doing this for our future, and just think about the time that it has to grow until we're at the time where we need it. The possibilities are just amazing.
It's a really good feeling opening the account and seeing your total sum of money.
We've already seen in our wealth creation series how Bryan and Crystal broke that paycheck to paycheck trap with a side hustle, and then how Crystal is building her passive income business to create wealth. Now, I'll show you how they finally got started investing and how it's changed everything they thought about stocks. In this video, I'll give you a step-by-step for how to invest in stocks. We'll start with the basics of how stocks work and why you can't wait to start investing. I'll show you the different investment types and the easy way to read a stock page. Stick around, because then I'll reveal 6 simple ratios to compare stocks. Along the way, we'll be following Bryan and Crystal's journey as they start investing and what they've learned, because you're going to hear a lot of the same questions, fears, and doubts you might have about getting started investing. You're not alone in this, and I know you can get started. But we can't get started here on the channel without that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're new here, don't forget to join the community and check out the playlist in the video description below. Besides explaining the stock market in this video, we're following Bryan and Crystal's story in 5 videos to take you step by step in creating wealth, from making money to investing and beyond. Now, if you are new to the community, a little bit about me. After serving in the Marine Corps, I started in real estate analysis and went on to over 10 years as a professional market analyst for venture capital and private wealth management. I hold a master's degree in business and the Chartered Financial Analyst designation, a 3-year professional track for those in the stock market. But we're not here for me, we're here for you. So what are your questions about the stock market and investing for beginners? I'm always updating this video, so let me know in the comments below what you want to know. And your first question might be, what are stocks? So let's start with the basics of the stock market and how you make money. Now, it might sound fantastic, but a stock is actually a part ownership of a company. Companies need money to grow and have 2 choices here: to either borrow money through a bond issue or sell a part of the company to investors. Now, for example, there are just over 16.4 billion shares of Apple, and each one represents an equal ownership share in the company's profits and any cash payout they make. Now, of course, each share is only a tiny fraction of the ownership of that whole company, so you would have to own almost $26 billion of those shares just to have 1% of Apple, but the fact remains, every Apple shareholder has a right to the future profits as long as they hold that stock. Now, from that, each share of stock gets an equal claim to any future earnings and dividend payouts, and that's where stocks get their value. First, from the value of those dividends. Apple doesn't pay much of a dividend here, but only about 88 cents a share paid out in 4 installments a year. But it also made $5.62 in profits per share over the last year. And like most companies, Apple doesn't pay out all of its earnings to the owners, those stockholders, but it does have kind of an unwritten agreement. Now, stockholders allow management to keep most of those earnings back, reinvest them into the company to grow those future earnings. And that's where the stock gets its other part of the value, from the future value of all those earnings the company is going to produce. So how you make money as an investor then is by either holding onto that stock, collecting those dividends, or by selling the stock for hopefully a higher price than what you paid. Now, that difference between the selling price and the purchase price is your return, and it's been very good, averaging over 8.5% a year over the last 3 decades. Now, some years are better than others, of course, and we'll talk about why that happens later, but overall, a very good return on your money. But then, as you saw in that chart, it's not a guaranteed return. If the company doesn't pay any dividends or look like it might have profits in the future, a stock's price can go to zero. There's just no value in owning a company without future profits. Now, sometimes the outlook for profits on the entire stock market can be so bad that investors rush to sell and the entire market price falls for a little while anyway. But to get those returns, to have your money working for you, you have to invest. So how much should beginner investors put in the stock market? Now, you're going to hear all kinds of those so-called rules like save or invest at least 10% of your salary, or calculations for how much you need to reach your goals. But in the beginning, I don't want you to get caught up in all that. Don't let thinking you don't have enough to invest stop you from just getting started.
Anybody can be an investor for, $1 a day. I started out with like $10 a week, but hey, you got to start somewhere. Now that I have gotten a little more comfortable with investing and the business, since we have the business, where I'm able to do $300 a month now compared to the $10 a week beforehand. So the business has afforded us to do that for sure. I mean, my goal is to get up to $500 a month. That way I can fully fund a Roth IRA, but we're still working, so we're getting there.
Now, folks, I know even $1 a day can seem like a stretch sometime. That's why we started our wealth creation series with that side hustle video and the passive income ideas. Check those out, because with more than 10 ways to make extra money, I guarantee there is something there that's going to give you extra cash that you need to invest. Now, even with those basics down, understanding stocks can still seem like a foreign language. And when I traveled to Colombia in 2006 to do consulting around the free trade agreement, I thought I understood all the Spanish I needed. I had spent a year learning in class and thought I was ready until I got to Medellin and couldn't understand a damn word they were saying. It is the same way with stocks. You watch videos and everything seems so simple, but then you click over to Yahoo Finance and it just looks like a jumble of numbers and percentages.
I think the most confusing part is just honestly understanding all of it, If I feel like it's always been over my head.
Luckily, I've watched a lot of YouTube, so I knew some things. It still was the fear of not really knowing what you're doing, not really knowing the terms of investing.
So now I want to show you the basics of how to find some of the most important information about a stock, how to read a stock quote. I'll be using this stock quote page from Yahoo Finance because it's free and accessible for everyone, but you can get the same thing here on any investing app or platform. So the first thing you're going to see is the name of the company and the ticker symbol, which is just how you find that stock. Now, a lot here isn't that important for the beginner investor, so we're just going to skip around to the good stuff. The 52-week range here is the highest and lowest the stock has been over the last year, so helpful in seeing if the stock has jumped or fallen. You can also see this if you click on the chart to the right and for that 1-year time frame. Now, this market cap here is the market value of the company. It's the stock price times the number of shares available. So what investors are saying this entire company is worth. And next here we've got the price to earnings ratio, this PE ratio, and this is probably the most popular metric in investing. I'll define it quickly here, but we'll go deeper into it later when I talk about comparing stocks to buy. Now, the PE ratio is just a measure of how expensive a stock is, the price investors are willing to pay for each share of stock compared to how much in earnings the company is making per share. Just a few more notes on the stock quote page here. Now, this dividend and dividend yield is the amount the company pays out on a yearly basis. So Apple here pays $3.28 in dividends per share over a year, and then divide that by the stock price for that dividend yield. So that $3.28 divided by the $319 per share means Apple pays a dividend yield just over 1% a year. And remember, that's paid out on a quarterly basis. So you're going to get about 82 cents a share every 3 months. And let's look at a few more of these menu items across the top here, because there is really a lot of great information and analysis for stocks. All of this is going to be available on most stock investing apps, so I'm going to cover the basics for beginners here. This chart will allow you to see what the stock price did over different periods, from 1 day all the way up to 5 years and the stock's lifetime. I like using the comparison here, where you can enter in any name of another stock and see how well it did over that period. So we see here that over the last year, shares of Apple have gained 34%, while Tesla is up 84%. This statistics tab is where I spend most of my time, and you're going to find a lot of useful information here. It's going to calculate a lot of the valuation ratios that we'll talk about later in the video, like that price to earnings ratio. Now understand though, sometimes these ratios can differ depending on how the app is recording numbers directly from the financial statement. So it's always good to double check these and know what you're looking for. One thing I do want to point out, this share statistics, you're going to be able to see how many shares are sorted, which has been a really important number over this past year. That short percentage is the amount the total shares borrowed and then sold short. When it's really high, like it was with GameStop or AMC Entertainment, then you get the opportunity for a short squeeze and then the price to jump higher. It's a little more complicated than we want to get into here, but I'm going to leave a link to a full video on using that number in the video description below. You'll also find some great analysis like profitability ratios and return on equity, both of which I'll show you how to use later, as well as some information here on the financial statements. For this historical data tab, I actually want to switch it over here to a dividend paying stock because that's what I use it for most. You can change the time period here and see a history of the stock price, or you can change this to show only the dividends paid. It's a great way to check that a company has been paying out its dividends regularly with no missed payments, and then how much it's increased the payments over years. If you're not sure what a company does, you can always check this profile tab to see the sector and the industry in which it operates, as well as a short description of the business. Here in the financials tab, you'll find all the reported financial statements, which I'm going to explain how to use those and how to read those here in the video. Now, one thing to notice, these here on Yahoo Finance might not include every number that the company reports on its official statements, which you can always find by doing a Google search for the company name and investors relations, then just looking for the downloadable financial statements. But overall, you're going to find most of what you need right here. The analysis tab here is a quick summary of what Wall Street analysts think the company is going to report for earnings and sales over different periods. Now, not only is the trend important, so seeing that a company is expected to report higher profits, but you can use these numbers to analyze a stock's valuation. The options tab is another favorite of mine, but way beyond what we want to cover here in a beginner's stock market video. Options give you the right to buy or sell a stock in the future, and it's a great tool to increase your returns or even lower your risk. I've got a full video on my 5 favorite options investing strategies and a step-by-step to how options work, so look for that link in the description below as well. Now, all you out there in the nation know we love talking stocks here on the channel, but it actually isn't all about stocks. In fact, let's look at some of the other investments that you have available and why you might need those as well as your stocks. Now, the other major investment besides stocks are going to be bonds, which is like a loan to the company. Companies sell bonds to investors to borrow money. Most bonds pay a fixed percentage of interest in 2 payments a year and then pay the borrowed amount back at the end of the loan. And now, because bonds are a debt obligation of the company, the interest and the borrowed amount has to be paid back. As long as a company doesn't go bankrupt, bond investors know exactly how much they're going to make at the end of that investment, so there is much less risk than with stocks. For example, this Vanguard bond fund pays a dividend yield of 2.9%, more than twice the dividend you get on the overall stock market. And if you look at this price chart, you'll see what I mean about safety. When stocks lost half their value in 2008, the bond fund actually produced a positive return on top of those dividends. When COVID sent stocks crashing 35% last year, bond prices fell about 10% in this fund, but rebounded really fast. Now, stocks do beat bonds for that long-term return over many years, but bonds serve their purpose for that safety, especially when the stock market gets a little expensive or when you just want a little less risk. And now, actually, looking at that bond fund is a great example of not really a type of investment, but a way to invest, and exchange-traded funds, or ETFs. Now, these are portfolios of stocks, bonds, or other investments grouped and then managed by a professional manager to give investors easy access to that theme. You can buy ETFs just like you do any other stock, and you get an instant investment in everything that the fund holds, all the stocks or the bonds in that group. For example, you can always buy individual bonds from different companies, but you're going to have to pay a commission on each one, and you'll need to buy a lot of different bonds for that extra safety. Or you can just buy shares of this Vanguard BLV fund, which holds almost 3,000 bonds spread across different types of companies and with different credit ratings. Now, for that convenience of being able to invest automatically across everything in that fund, the ETF is going to deduct an expense ratio to pay management. And for a lot of these, especially the Vanguard fund, that expense ratio is almost nothing. Here, a 0.05% expense ratio means a fee of just 50 cents for every $1,000 you have in the fund. There are exchange-traded funds for just about every investing strategy, including dividend-paying stocks, real estate, and bonds. It's a great way for beginner investors to put their money to work without worrying about even picking individual stocks. And there are actually a lot of investors that buy nothing but ETFs. Now, the last type of investment, before I reveal some of the most popular investing strategies, is a special place in my heart: real estate investment trusts. Real estate trusts, or REITs, are companies that own real estate and then sell shares just like any other stock. The company collects rent on those properties and then doesn't have to pay income taxes as long as it sends 90% of its income to investors through a dividend. And that means you get a great way to invest in real estate without tens of thousands of dollars in costs to a property yourself, and you get a great dividend yield stock. Nation, I got my start as a real estate analyst so many years ago, and no other type of investment has produced as much family wealth as property. REITs give you the opportunity to invest across a whole portfolio of real estate and properties across the country. For example, one of my favorites here, Stag Industrial, ticker STAG, owns millions of square feet of warehouses across the U.S., with the stock price up 80% over the last 5 years, besides that 3.4% dividend yield. And since those REITs own real property, the value is backed by those hard assets. That's going to help support the price of those shares, so not only do you get a great return with these real estate stocks, but holding them along with other stocks means you're not going to lose half your money when the stock market crashes. No, I don't want to, but the next section, we have to talk about the scary stuff, the risks in stock market investing. Because the fact is, nation, all investment is going to involve risk. You're putting your hard-earned money down on a company on the promise that it's going to make more money in the future and investors are going to pay more for that stock. So then if you think about that, there are two risks you need to know about. The obvious one is that the company just doesn't make more money in the future, that the earnings or profits fall or flatten out. Now, lower earnings, assuming investors are willing to pay the same price per earnings as that, it's going to mean a lower share price, and you're going to lose money. The other risk, though, is one most beginner investors don't think about it, and it actually costs more in losses. The other risk is that even if the company does increase its earnings, investors will still pay less for the stock. Now, let me show you an example of this, and then I'm going to reveal how to lower this risk. We see here a chart of PayPal's earnings reported each quarter, and I've added some stock price detail as well. Now, the shares hit an all-time high, just over $300 in February. At that point, the company had reported its Q4 earnings, with the last 4 quarters adding up to $4.74 a share in profits at that point. So at that point, with the stock price at $300 a share and $4.74 in share earnings, investors were willing to pay a price of more than 63 times those profits, that PE ratio. Now, fast forward to November, and the company has reported earnings of $4.56 a share over the last 4 quarters. It's a slight drop from that February total, but there's nothing in the company's progress that would make us think that it won't make more money in the future. In fact, Wall Street analysts expect the company to make a total of $4.88 a share in earnings over the next year. So the company is doing well, will continue to produce and grow those earnings, and yet it doesn't change the fact that the shares have plunged to $187 each. The stock is now trading for a price of just 41 times earnings because investors are just willing to pay less for the shares. Now, the good news is that there are 2 ways to avoid this risk when you're investing. First is just to hold your stocks for years and don't worry about what the price does over a few months. I own shares of PayPal and have no doubt in my mind that earnings will be much higher over the next 5 years and even longer. Now that means even if investors are still only willing to pay a price of 41 times earnings in 5 years' time, if earnings have grown to over $9 a share, then the stock price is still going to have risen to $376 for a total return of almost 100% from here. Now, the other way to avoid this risk is to use what's called a value strategy to investing, something we'll talk about in our next video on starting investing. Or if you're going to use a growth stock investing strategy, still pay attention to that PE ratio and how much you're paying. Just these 2 tips are going to help you not fall into that trap of paying too much for a stock only to see the share price fall. Even being able to avoid that risk, all you have to do is take one look at this stock chart to wonder if investing is just another form of gambling. And while it's true that stock prices do go up over time, over any given year, it seems like a crapshoot, a 50-50 chance that stocks are going to go up or crash lower. Now, of course, it's not a 50-50 shot that stocks are going to fall in any given year, but it does happen, and it seems like that way sometimes. Even with the risks, though, investing is not just gambling. When you throw those dice at a craps table, you have no control over the outcome. And in fact, the way the payout is planned, the casino has the advantage. Now, that bet is also a one-shot opportunity at the casino. You throw the dice and you either win or lose. You can throw the dice again, but it's going to be the same lousy odds. With investing, though, you're going to be able to put the odds in your favor by using research to find good companies. Your investment isn't a bet whether the company is going to make money this quarter or next, but that it's going to make money over years to come. Now, you can control the outcome of this through the kind of research and analysis that we do right here on the channel.
Definitely something I feel different now than when I started is it's not too risky to put your money into the stock market. You got to quit listening to people telling you it's too risky. There's so many other things out here in the world that are more risky than putting your money in the stock market.
So no, the stock market is not too risky, and it's not gambling, but The fact is, there are going to be times that stock prices fall and fall a lot. A bull market is when the price of a stock or the stock market rises 20% from its recent lows. Now, a bear market then is when a stock or the market has fallen 20% from its recent highs. And here we can see a history of bull and bear markets for US stocks. Now, the blue areas are bull markets, and as you can see, have averaged just under 3 years long with an average return of 111% during each period. That's double your money. But you don't get the bull without the bear, and bear markets have lasted on average about 9.5 months, with an average loss of 35% from that bull market peak in the price. Of course, that's when investors start panicking, both experienced and beginner investors. And when stocks do fall, I just need you to remember two things. One is obvious from the chart, is that bear markets do end, and actually very short, less than 10 months on average. Now, I know when stocks are falling, it can seem like they'll never come back up, but they do, and usually pretty quickly. The other fact to remember, though, obvious in the chart that we saw earlier, is that stock prices will recover and eventually always head higher. Even after that massive sell-off in 2008, where stocks lost half their value, stocks were back up to their prior highs within a few years. And like we saw in shares of PayPal earlier, the stock is down, and it sucks to see your investment drop after making it, but you cannot let that panic you into selling. Take that long-term approach and know that your investment will pay off.
I never let the stock market affect how my day goes. I mean, there is maybe a few times that you can feel it in the pit of your stomach when something's really down, but I don't. It's not something I let affect my day by any means, because I know time is your friend and it'll always come back.
You are ready. By now, you know what you need to know about the stock market and how it works. Now it's time to get down to business and look at how to find stocks to buy. Now, there are primarily two ways to pick stocks: a fundamental analysis, which we'll look at now. And this is what most investors do, looking at the value of the stock based on its earnings and the future of the company, really trying to understand what makes that stock better than others. Now, the other way to pick stocks, and I'll go into this in more detail in our next video, is called technical analysis. Now, this is where you're looking at patterns in the stock price and trying to forecast what the price is going to do next. This is usually a shorter term way to invest, because you're looking for how those patterns have affected the stock price only over maybe a day or a week at the most. To start in on that fundamental analysis, there are 3 financial reports you need to know about. We're going to look at each of these, what they show you, and how to use them in your analysis. These reports are released every 3 months to update investors on the company's quarterly results, and then each year in what's called a 10K annual report. Now, understand, my goal here isn't to make you a Wall Street analyst. And people study years to do that. Like I spent more than 1,800 hours studying for the Chartered Financial Analyst exams, besides all the accounting and finance coursework I did before that. What I want to do here is just give you the basics to make you a better investor, take you beyond that beginner investor level. With what we'll cover, you'll be able to do your own analysis in stocks. You'll be able to give yourself a second opinion when you hear someone talk about the stock or a stock pick on TV or online.
So much of it out there it's hard to understand. You know, they talk in circles and they talk around things, and they'll make a bad company sound great, but do they really know? I mean, there's so many people out there, I think, misleading people. One thing I think that all investors need to know about when investing is how to, I guess, analyze a company to make sure it's not necessarily just a company, an ETF, an index fund, anything, just to make sure that it is a legit investment.
We'll start here with the income statement, and this is really the most popular among investors. It's the one you see most talked about because it gives you that breakdown from the revenue, the sales, all the way down to the bottom line earnings for the last 3 months or year. Now, this is an important financial statement, and I'll show you some of the measures to use in your analysis, but it's going to surprise a lot of investors out there that this isn't actually the most important of the 3 financial statements. Analyzing a stock, and in fact, as a professional analyst, you're going to spend the majority of your time on the statement of cash flows, which we'll get to next. It's this statement of cash flows, the cash flow statement, that gives you a better look at the cash generating power of the business and just a purer look of how well the company is managed. But let's get back to the income statement for now, because there are some great things here you want to watch for in your analysis. Your income statement is going to start with that total revenue, how much the company booked in sales over that period. Here we see Apple reported just over $260 billion in sales for all of 2019. And just under that is the cost of goods, or sometimes abbreviated COGS. Now, this is the cost of supplies and materials that go into each product. Now, the first thing you can look at in the income statement is that trend in revenue. Is it moving higher or lower, and at what rate? Here we see that the revenue for Apple actually did fall by $5 billion in 2019 from the year before, but it's been trending higher over the last few years. We can also get a growth rate by dividing 1 year, so let's say 2019 revenue of 260.17 by a previous year, so 2016 revenue here of 215.64. Now that gives us 1.2065, and since it's over 3 years, what we do is we take the exponentials, that 0.33, to get a number for annual growth, or 6.4% yearly growth in revenue. Now, a couple of quick points here. I know this is a lot of math to throw at you, but it's pretty basic stuff once you get used to it, and absolutely critical to understanding the financials of a stock. So finding the growth rate is just going to be dividing one number, 1 year's number, by another, and then getting an annualized rate, kind of like an average. Now, don't feel like that you need to master all the math here, though. Just getting the basics down is going to take you beyond 99% of the beginner investors out there. Now, the next section of the income statement is going to show you the operating expenses and profit. Now, these are the core expenses to run the company, like selling, general and administrative, or costs for marketing. Towards the bottom here, you're going to see the operating profit, which is just the gross profit from above, minus all these operating costs. Now again here, you want to look for that general trend in the operating costs and where they're coming from. For example, I can see that costs for selling, general, and admin have trended up from $14 billion in 2016 to $18 billion last year. And where this really gets helpful is in comparing the increase in costs to that increase in revenue. So if we want to get an annualized growth in those SG&A costs, we do that the same way we did for revenue. So by taking 2019 costs of $18.25 billion divided by 2016 costs of $14.19 billion, we find that Apple's costs have increased at an 8.7% annual rate. So then just looking at this would be a warning sign. Not only did Apple's revenue decrease over that last year, but over the last 3 years, its selling and administrative costs to run the business have increased at an 8.7% annual rate, while those sales have only increased at a 6.4%, a lower rates over that period. Now here we would definitely want to compare these numbers with some of the competitors like Samsung or Sony. Are they facing that same slow sales growth but increasing cost environment? Or is it something that Apple alone is struggling with, and maybe why? And in the next section, I'll show you some of the easy financial ratios that you can use with this income statement to compare those stocks, but here I want to just stick with the basic financial statements. Next here we have the balance sheet, and this shows the assets, so what a company owns, the liabilities, so everything it owes, and then what's left over for investors. So here on Apple's balance sheet, and this is always going to start with your cash and cash equivalents. This is the actual cash the company has, or very short-term investments that can be converted into cash quickly. And here we can see that Apple has spent down its cash over the last quarter, from having $107 billion in that first quarter to $94 billion in the most recent one, but it's been fairly stable over the last several quarters. Here we don't really need to find a growth rate, but we will be using this cash number later on. Now the next section, and this is something most investors totally ignore, but it can be priceless in finding the problems with the company. We'll look at this total inventories number and the trade or other receivables number. Now, inventories is going to be your unshipped products. So if this is trending higher or has a big jump in any given quarter, does it mean that the company is having a hard time selling its products? Is it producing something that customers don't want right now and the warehouses are filling up? More important though is this trade and receivables number. Now a lot of companies, when they get into trouble or especially during a recession, they're going to sell a lot more of their product on credit. They'll ship out product to customers and give them 30 or 60 days or even longer to pay. And this is one of the biggest hints that we see in a company when it gets into trouble, or those accounting shenanigans that management likes to play to make them income look better. You have to watch this trend in receivables because it is such a common way to inflate those sales. Basically, management is extending credit to customers even if it knows it's likely that those customers aren't going to end up paying back those sales. They just want to book those sales, so they're giving credit to anyone. Now, further down on the balance sheet here, you're going to find longer-term assets like this property, plant, and equipment that the company owns, as well as longer-term investments. Now, these aren't quite as important as those current assets, though, so we'll move on to the next section here. And next are the liabilities, and just like those assets, these are split between the current liabilities, which are going to be things like the company needs to pay within the next year, and then long-term liabilities that might stretch out for decades. Now this trade accounts payable is kind of the mirror opposite of the receivables we looked at earlier. So this is the materials that the company has bought on credit and still needs to pay for those back. And you can look at this trend to see if the company is maybe struggling to pay some of its short-term creditors. And these current liabilities tend to be a small part of the company though, so I usually just skip down to those non-current and the long-term debt. Now this line for long-term debt is easily one of the most important on the balance sheet, especially during any time of a recession or economic weakness. It's during these times that you really want to watch your stock picks to make sure that debt isn't going to get them into trouble until the economy picks up. So you can look at that general trend in the debt here, or you can use a couple of the ratios that we'll look at later. And you can compare the cash on hand to see how much debt the company had. Something else you can do is you can compare the cash on hand or that cash equivalence to how much debt the company has. So does cash pretty much cover the debt, or is the company buried under a mountain of liabilities? In this last section, the shareholders' equity really isn't used as much as the others, except for a few ratios. You'll use that return on equity and the debt to equity ratio, so a measure of the investor return and leverage, but the debt and cash section of the balance sheet are usually much more important. Finally here, this last statement, the statement of cash flows, is almost totally neglected by investors, but I gotta tell you, is the single most important statement for analysts. The statement of cash flows is going to show you all the actual cash in and out of a company over a period. Now that's important though, because it's going to clean up some of the accounting tricks and even shenanigans that management uses on the income statement. Management can always fudge those income statement numbers by giving more credit to buyers or just slow paying its bills. It can book sales early or even hide some of its costs on the balance sheet. But since the cash flow statement is actual cash in and out of the company, you don't get those accounting tricks here. You see that pure picture of the business. Now the statement of cash flows is broken into three sections: cash from operations, investing, or financing. And we'll look at all three, but really the first one here is the most important. This cash flow from operations is that pure cash generating power of the business. It's going to start here with a number the company has reported as income on that income statement. Then it's going to adjust that for some of the non-cash accounting tricks that the company uses. Now understand, when I say accounting tricks, these aren't necessarily shenanigans or even lies or illegal things that the management is trying to get over on you. The biggest one here is just going to be depreciation, so the amount the company takes off its income to account for used up assets. Now this number gets taken off the income statement as an expense, but it's not an actual cash that the company has to pay or spend out. So it kind of fudges what the business is really earning. So you're going to have the income or the loss reported, then all these adjustments, and at the bottom, you're going to see what's called the total cash flow from operating activities. Now, even if net income or the earnings for the company is negative, you want it reporting that positive operational cash flow, or the company could be seriously in trouble. Now, you can use a lot of this in your analysis and the ratios that we'll talk about later. In this next section, the cash flow from investing activities shows the long-term investments and the spending the company is making just to grow the business. This can include things like money spent on research and development for new products. It can be acquisitions of other companies, or the other side of that, selling segments of the existing business. So here you really want to look for those big, uncharacteristic changes. Things like, did the company make a huge acquisition, which would mean I would really want to take a close look at what the company bought, how much it paid for it, and whether I think management can really integrate that other company into the business for higher returns, or did it just overpay for something? By the same token, you also want to watch this for decreases as well. Did the company cut its research and development spending by a lot, and how is that going to affect product development and its competitive edge? Is it selling off segments of the business, and how is that going to affect future earnings? The third section here, this cash flow from financing, this is going to include dividends paid, shares issued, and changes in cash from debt. Again here, it's just the big changes or the trends is what you're looking for. Is the company issuing a lot of debt or just paying it off? Is the company spending more for dividend increases even as it borrows more on debt? Or is cash flow from operations decreasing, so not even covering that dividend payment? That's actually what happened at IBM over the last decade and resulted in one of Warren Buffett's worst investments. You could have seen it all right here on this cash flow statement. Now, the cash flow statement is going to finish up by adding up all these three sections to show you the change in cash over that period. And one thing I'm surprised Morningstar isn't showing here on this statement, which is why we'll use Yahoo Finance here, is what's called free cash flow. Now, free cash flow is just a measure of additional cash the company is generating after paying costs to keep that business running. You're going to find this by taking that operational cash flow, so the cash generated from the business, minus capital expenditures, which are always going to be found in that middle section of the cash flow from investing. So you've got the actual cash collected by the company for running that business, and then this capital expenditures, or sometimes this is called investment in property, plant, and equipment. This is the spending the company needs to do just to replace that old equipment and basically keep everything running. So taking that money spent to keep the business going from the cash generated from the business, This gives us the free cash flow, or a measure of the cash generated on that ongoing basis. And just like with these other numbers, you're going to want to follow the trend here and make sure that any stock you buy, the company is increasing that cash generating power. Now, I know the first time you look at those financial statements, you're probably going a little bit cross-eyed and it just looks like a bunch of numbers. This isn't something you need to pick up on one sitting, but what's important here is what you can do with these, and that's give you a start to comparing stocks. You see, finding stocks or getting stock recommendations is the easy part. You see these every day. The lists of stocks to buy and even the stock analysis that we've covered so far is still going to leave you with dozens of potential investments.
What made me most nervous about starting investing was really losing my money. Investing in something that wasn't just going to bottom out and lose my $10. Even though it was just $10, I didn't want to lose it. So it was just trying to pick a good company to put the money into.
And that means you're going to need a way to compare stocks and then narrow down your list to only the best to buy. In this section, I'll show you 6 financial ratios you can use to compare stocks. Each of these financial terms is a quick and easy way to measure stocks, either on valuation or performance, to decide only which ones to buy. And our first is easily the most popular, the price to earnings ratio. Now, I guess before we even get into these, I know I'm going to lose about half of you out there if I say this is math, so I'm not even going to say it. Every one of these ratios can be done with a simple method, and usually if you look at the term, it's going to tell you exactly what to do. And for example, this price to earnings ratio is just what it says, the price of the stock to its earnings or profits of the company. You take the share price divided by the earnings per share, and that's going to tell you how much investors are willing to pay for that stock, how many dollars for each dollar in profits. For example, we can see here that shares of Tesla are at just over $1,082 each, and if we scroll down, we can see the earnings per share over the last year. I'll add these up, and we can see that the company has made $5.04 a share in earnings. So if we take that share price and divide by the earnings per share, we see that Tesla has a price to earnings ratio of 214 times. Investors are paying $214 for every dollar in profits that the company makes. Now, a lot of investors misunderstand the PE ratio though, so this next part is extremely important. Now, the price to earnings ratio gives us a measure of relative valuation, and that word relative is the most important part. A lot of investors think that the P/E ratio tells you if a stock is a good investment, which stocks are cheap and which are expensive. For example, if I were to compare Tesla versus Apple, I have to pay a price of 214 times every dollar in profits for Tesla stock, whereas I can get a share of Apple for 28 times its earnings. Apple trades for a price to earnings ratio of 28 times. Now, beginner investors might look at that and think it automatically makes Apple a better investment because the shares are cheaper. I only have to pay a price of 28 times each dollar of profit versus 214 times. But that's not really what the price to earnings ratio tells us. And remember that word relative here. It means in comparison. The PE ratio tells us how stocks are valued compared to others or even compared to the PE ratio of the entire stock market. Now, the problem here is that while shares of Apple might be cheaper compared to Tesla because the PE ratio is lower, it doesn't automatically make Apple a good investment. Maybe the PE ratio of both of these are expensive and neither is a good deal, or maybe the PE of both is cheap and would be both good investments. Now, one thing you always need to do when comparing stocks, especially when you're using this PE ratio, is look back at the average PE ratio over the last few years on a stock. If I go here to Morningstar and look at the PE ratio for Apple over the last few years, I see it's been as low as 11 times in 2015 and averaged 22 times over the last 5 years. So looking at this, even though the PE ratio of Apple is cheaper relative to Tesla, it's actually expensive compared to the stock's own history. Investors right now are just willing to pay more for shares of Apple, 28 times each dollar of profits, but have only been willing to pay 22 times in the past. Just remember though, when you're using the PE ratio to compare stocks, first, it only tells you which stock is cheaper or more expensive compared to the other, not necessarily which is a good investment. For that, you're going to need to use some of the other analysis or the ratios together. Also though, besides comparing that one stock's PE ratio against another, you also want to always compare a stock's current PE ratio with where it's been in the past to see if it's relatively cheaper or more expensive than it has been. Now, one more thing to remember about the PE ratio is it's going to be very different for different companies. Like we saw for Tesla, investors are willing to pay $214 for every dollar of profits, but only willing to pay $28 for every dollar of Apple earnings. Now, why is there such a huge difference for what's arguably two very good companies? And the answer to this is just growth. If we look at how fast Tesla is growing its profits, we can scroll down here and see in the most recent quarter, the company booked an increase of 56% in earnings over the last year. Now compare that to Apple, and we see the company only booked an increase of 28% in its earnings over that last year, which is still pretty spectacular, but exactly half as fast as Tesla. So just think about this. Wouldn't you pay more for a share of profits in a company that's growing those profits by 56% versus one only growing by 28% a year? You bet your ass you would, but that kind of muddies the comparison, doesn't it? How do you compare the PE ratio between Tesla and Apple when the growth rate in the earnings is so different? And the answer to that is actually our second ratio, the price to earnings to growth ratio, or PEG. And this little change to the PE ratio is going to make it so you can compare those seemingly expensive growth stocks against others to see which are really cheaper or more expensive. And the formula here is exactly what it looks like. You take that PE ratio and then divide by the growth rate of earnings. For example, we had a PE ratio of 214 on shares of Tesla and an annual growth of 56%, or just 56. So 214 divided by 56 equals 3.82 times on that PEG ratio. Now, on the other hand, shares of Apple were trading at 28 times on that price to earnings with a growth rate of 28%, or 28 divided by 28, which equals 1. And what we find here doing this comparison is kind of a confirmation. This tells us that the shares of Tesla are more expensive than shares of Apple, even when you account for that growth of each company. That PEG ratio is a great tool for adjusting the stock comparison for those super fast growth companies that you see in some of the most popular stocks, just to compare them on an even playing field with some of your older companies. From valuation measures to one that measures the effectiveness of management, how well management is able to grow profits, we have the ROE, or return on equity. The ROE is the company's net income, or its earnings per share, those profits you find on the bottom of the company's income statement, then divided by the amount of shareholders' equity, that found on the bottom of the balance sheet. Now remember, the shareholders' equity is just the assets value of the company, so everything that owned by the company after deducting what's owed on debt, so the balance sheet value of the company actually owned by investors. So if you think about this, that return on equity is how much profits management is able to create using investors' money. So how well does management take that shareholders' equity and create profits from it? And there are a few ways to use this ROE to compare and find the best stocks. Now, one is just comparing the ROE of one company against another to see which has management better able to generate profits. Like we saw before, though, another way is to compare a company's current ROE against its own history to see if management is just becoming better or worse at squeezing out those profits. And for any of these, the change from one year to the next may not mean that much, but what you want to do is you want to look for trends over several years. Obviously, you'd have to be worried if management was getting progressively worse at making those profits, if that ROE was falling over a period of years. You can also compare the company's ROE against the average ROE in its industry or in a sector. So how well does Tesla management generate profits versus other car makers, or how well does Apple do that versus other consumer electronics companies? And that actually brings up a really important point that we need to talk about before moving on to the next stock market term. All of these ratios are going to be different across industries and sectors, especially that return on equity. And what I mean here is because of how different the market is for, say, electric vehicles versus consumer electronics, that's going to mean it might not be as simple as just comparing Tesla's ROE against that of Apple. For example, Apple has an ROE of 147%, which means management is able to get a return of net income of 1.47 times the company's equity. Now compare that to Tesla, which has an ROE of just 15%, which is the company's income of $3.5 billion over $23 billion in equity. Again, that's a huge difference in the ratios in these two companies, but what you have to remember is that industry for making electric vehicles, the operating costs, revenue, and everything that goes into that is nothing like that of consumer electronics. So comparing the ROE straight across isn't really a fair comparison. You can still compare the ROE across two stocks, but you also need to compare each company's ROE, each company's return on equity against others in its industry. For example, how well does that management at Apple do in turning the equity into profits compared to similar consumer electronics companies like Garmin? In turn, how well does Tesla management generate profits compared to Ford or GM? Now, doing this across these ratios is not only going to help you compare stocks against each other, but it's also going to help you pick the best company within each sector, what we call the best of breed. This next ratio, the gross margin, could be one of the most important over the next few years because it's going to help you find the companies best able to withstand inflation. The gross margin is a measure of profitability, so how well does management turn revenue or sales into profits? In this case, the gross margin is the gross profit divided by a company's total revenue. So you see here on Apple's income statement, at the top you have the total revenue of $365 billion in sales that the company made over the last year. In this next line, you see the company paid almost $213 billion to make those sales, this cost of revenue. Now that's going to include things like paying suppliers for parts and some production costs. The gross profit then of $152 billion is that total revenue minus those costs. So then if we take that gross profit divided by the revenue, or $152 billion divided by $365 billion, we get the gross margin of just under 42% for Apple. And then if you think about this, you see why it's so important when inflation is going to be such an issue. A company raising its prices to answer for inflation is going to have higher sales, but it's also going to have those higher costs to create those sales. So inflation in its own supplies and other costs. So if we look back at the income statement for Apple, here I've calculated the most recent gross margin as well as the numbers in 2018 and 2020. And what we see here with these numbers is maybe Apple has seen the cost of its supplies go up on inflation, but it's also been able to increase its prices. In fact, the sales have grown faster than those costs. So Apple has been able to increase its gross profitability from 38% in the past to almost 42% now. So what you want to be on the lookout for over the next few years is with companies with a decreasing gross margin, where that cost of goods sold or the cost of revenue has increased faster than those sales. And that could mean that the company is having trouble passing on all of those higher costs, that inflation, onto customers through higher prices. That's a great example of how to use those ratios, not only to compare stocks, but also to see which companies are doing best against some of the factors that we're seeing in the economy. Now, all you out there in the Bowtie Nation, you're going to recognize this next ratio because it's arguably my favorite, the operating margin. And the operating margin is very similar to that gross margin. It's a measure of profitability. So how well does management turn those sales into profits? And here again, you have the company's total revenue at the top of the income statement and then the cost of that revenue below that. Just below that, you have all these operating costs or the costs of things like employees, marketing, administration, and research, that core costs to run the business. So if you take that number, the operating profit, divided by the total revenue, then you're going to get the operating margin. For Apple, we see it's almost $109 billion in operating profits divided by $365 billion in sales, or an operating margin of about 29.8%. Said another way, the company is able to create operating profits of about 30 cents for every dollar in sales. And now the reason why I love this operating margin so much is because it's that core measure of profitability for a company. Now, how well does management turn its sales into profits after paying for supplies, but then also all the costs to run the business? Are those costs like wages or marketing running way up ahead and eating into the company's profitability? Is management actually becoming more efficient and turning higher profits? So then comparing this against other companies as well as a company's own trend in its profitability is just a great way to find those stocks to buy. From measures of profitability to a measure of risk with the debt to equity ratio. Companies have borrowed trillions of dollars over the past few years, so this one is going to be just as important to make sure you're not investing in a company that is in over its head in debt. And like most of these, the debt to equity ratio is just what it says, the company's debt or total liabilities from the balance sheet divided by that shareholders' equity. Here we see Apple owes $241 billion in liabilities, and then the shareholders own $134 billion in equity for a debt-to-equity ratio of 1.8 times. Now what this tells us is that Apple owes debt of 1.8 times the amount shareholders own of the company, and debt is 1.8 times that equity. Now just like a lot of these other ratios, that really doesn't tell us much in isolation. We then have to compare that debt-to-equity ratio against similar companies and against the trend in Apple over the last few years. And doing this is going to tell us if Apple owes more relative to its competitors or its own history. And why this is important is that debt can get out of hand very quickly, especially if the economy stumbles. A company that owes too much might find it harder to make those interest payments if its sales fall. And because it has to prioritize repaying that debt, it might also have to limit the amount it spends on marketing or developing new products or all the other things that make it more competitive.
I don't think we will ever stop investing because we have been able to see what it can provide for us in the future, and just seeing, what you've put in and what it's already made. I mean, why would you stop? I want to get more people on board and, show them what it can do for you.
Check out the first 3 videos in our 2022 Wealth Creation series with the link in the description below, or click on the video to the right for the 7 passive income ideas that will work even when you don't want to. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.